Hello. I wanted to talk a little bit about variable and absorption costing today. Let me go ahead and pull up the Excel sheet. Okay, so I've kind of got an outline kind of laid out here of some of the main characteristics and differences between the two. So we'll start there and then we'll work through an example. So what both of these are ways for are ways that companies can account for their product cost within their financial statements. So variable costing is one way. And with variable costing, only variable cost are product cost. So your product cost would consist of direct materials, direct labor, and variable factory overhead. Now, one distinguishing thing with variable costing is it can be used only for internal use. Now, you'll find that it's very helpful for internal uses, but it cannot go outside the company, or anything reported using variable costing cannot be reported on any external financial statements or external reports. Now, fixed overhead is expensed off each period in total. Doesn't matter how much you produce, doesn't matter how much you sell, just the total amount of fixed factory overhead is expensed off each period. Variable costing uses a contribution margin income statement. And so that is also a distinction. And one of the reasons that it's for internal use only is that contribution margin income statement is very useful for internal purposes, but it does not follow US GAAP, so it cannot be used for external reporting. Now, absorption costing is the other method, and all cost of production are product cost. So product cost under absorption costing would be direct materials, direct labor, variable and fixed factory overhead. This is the US GAAP preferred method because it includes all cost of production within the product cost. It is required for external financial reporting. So anything that leaves the company as far as product cost must be reported using absorption costing. And it does use the multi-step income statement, which is the traditional format of income statement that you've seen all during the course. Excuse me. So there's three things I want to mention here, and you'll see these all kind of played out here in a couple of minutes as we get to working a problem. But kind of three rules that you're going to find here is net income will be the same under these two methods if sales and production are equal. So if we sell 5,000 units and we produce 5,000 units in the same period, then our income would be the same under both variable and absorption cost. Now, absorption costing will have greater net income if production is greater than sales. So if we produce 5,000 units and we only sell 4, then absorption would give higher net income. Now, variable costing will have greater net income if sales are greater than production. So if we sell 6,000 but only produce 5, then variable would give us a higher level of net income. So a couple of comments kind of from that. Absorption costing, and this is probably the biggest weakness of absorption costing, is that companies or parts of companies can increase net income by overproducing the product. Basically, what happens is when you overproduce, some of your overhead costs, which are product cost under absorption costing, fixed overhead costs, which are product costs under absorption costing, remain in inventory for whatever is not sold, but they're expensed off in total under variable costing, which can cause a difference between the two. And a company could actually benefit from their external reporting by overproducing. Now, and so basically this weakness is the reason that many companies use variable costing for internal decisions, for things such as bonus calculations and the like, meeting goals or setting internal goals, because you can't meet goals or you can't help yourself by overproducing like you can with absorption costing. So what a lot of companies do is they're required to use absorption for anything that leaves the company, and they do, but they will use variable costing for anything within the company that stays within the company. Now, so kind of one main thing to know from this is that under variable costing, your product cost is direct materials, direct labor, and variable manufacturing overhead. Fixed manufacturing overhead is expensed off as a period cost each period. Under absorption cost, product cost is direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. These are the four elements of product cost under absorption cost. So let's look at an example of this. So Flair Company sells a product based on the following information. The selling price is $25 a unit. Direct materials are $10 per unit. Direct labor, $5 per unit. Variable factory overhead, $3 per unit. Fixed factory overhead is going to be $40,000. And fixed selling and administrative costs are going to be $5,000. Variable selling and administrative costs are going to be $1 per unit. And production, they're going to produce 10,000 units during the period. So this is all the background information right here. So the first thing we'd look at is what is the per unit cost under variable and absorption costing? So under variable costing, remember that your product cost is all of your variable cost only. So in the example that we just looked at, under variable costing, the product cost would be the direct materials, the direct labor of $5, and the variable factory overhead of $3. So we would have a product cost of $18 per unit under variable costing based on the information that we had here, Now, what would that be under absorption cost? Again, it would be the direct materials, the direct labor, and the variable overhead, which were all reflected the same under variable costing, but also the fixed factory overhead. Let me put in factory right here. The fixed factory overhead per unit would also be part of the product cost under absorption costing. So how we would figure that is we would take the total fixed factory overhead and we would divide it by the units produced, which you see here in my formula. And this would be added to the other cost to give us $22 per unit product cost under absorption costing. So remember, under variable costing, all of your variable costs are your product cost. Under absorption costing, your variable cost plus your fixed factory overhead would be all of your product cost under absorption costing. The main difference between the two methods is how do they treat fixed factory overhead. Under variable costing, it's not a product cost that's expensed in total each period. Under absorption costing, it's included as part of the product cost. That is the main difference between the two. So what is the operating income if sales are as follows? If sales are 10,000 units, let me go ahead and write units out here, 12,000 units and 8,000 units. So what would your operating income be under both methods with this level of sales? And remember that we're going to use all of the same information that we talked about right here. So all of this, the product cost that we just computed under variable and absorption costing, this is going to be the information that we're going to need to solve this problem. So what we would do is let's do absorption costing first. So if our sales were 10,000, and remember we produced 10,000 units during this period of time, our sales would simply be the 10,000 units sold times the $25 per unit, and that would give us 250,000. And you can kind of see my formula right here. The cost of goods sold for absorption costing would be the number of units sold, 10,000, times the product cost under absorption costing, which is $22 per unit. So that would be 220,000. Sales minus cost of goods sold would give us a gross margin. And again, as you can see here, absorption costing follows a traditional multi-step income statement format. Now, we would then take away our operating expenses, which would be the variable selling and administrative cost, which you can see are the number of units sold times the variable selling and administrative cost per unit of $1. So that would give us 10,000. And then the fixed selling and administrative cost was basically given to us here as 5,000. That would also be deducted. And we would have operating income of $15,000. Now, if we were to do the same thing with the sales being the same amount, 10,000 under variable costing, what would our operating income be under variable costing? So again, the sales would be calculated the same way. The number of units times the selling price of $25 per unit right here. Then the variable product cost here would be your number of units sold times your variable cost per unit, which is 18 here, which would give us 180,000. Now, your variable selling and administrative cost here would be, again, the number of units sold times the $1 per unit variable selling and administrative cost here, which would give us a contribution margin of 60,000 in this case. Now, remember that variable costing uses a contribution format income statement, and it's a lot like your normal calculations of contribution margin. It's going to be your sales minus your variable cost equals total contribution margin minus your fixed cost equals operating income. So in the same way that break-even analysis and contribution margin break out expenses into what's fixed and what's variable, that's what we do here on the contribution margin format income statement that's used in variable costing. So we've got our total contribution margin of 60. We're going to take away the fixed factory overhead. Remember that under variable costing, you expense this off in total every period, which is 40,000, which was given to us here in the problem here, fixed factory overhead, 40,000. And then also the fixed selling and administrative expense, which is 5, which was given to us here, will also be deducted. And we come back to operating income of 15,000. Now, notice that the operating income is the same, 15,000 under absorption and 15,000 under variable. And you remember one thing that I said was one thing that we talked about earlier when we were looking over the rules. If sales and production are the same, we produce, in this case, we produced 10,000 units, we sold 10,000 units, then operating income will be the same under both variable and absorption costing. There's no difference between the two. Okay, so let's look at them now. What if we were to sell 12,000 units? Now, remember that we only produced 10. So in this case, we're selling more than we produce. So we would come up with our sales the same way as we did last time. We would take the unit sold times the selling price per unit, which is $25 a unit. We just looked at it a moment ago, and we'd get $300,000. Then we would take the number of units sold times the product cost under absorption costing, which is $22 a unit, and we would get 264,000. Sales minus cost of goods sold gives us our gross margin, in this case, of 36,000. Now, for variable selling and administrative cost, we would take the unit sold times the rate of $1 per unit, which was given to us earlier, get 12,000. And then we would take the fixed selling and administrative cost, which was given to us as a set amount, fixed amount, and doesn't change regardless of sales. So we would have operating income of 19,000 under absorption costing with sales of 12,000 and production of 10,000 units. Now, what would it look like under variable? Under variable, we'd again take the 12,000 units times the selling price of $25 a unit, we'd come up with 300,000. Then we would take the 12,000 units that were sold times the variable cost per unit of 18, and would basically give us what, 216,000 of variable product cost. Variable selling and administrative costs would also be deducted here, which would be the number of units sold times the rate, which is $1 per unit. And we would come back to total contribution margin of 72,000. We would again back out the 40,000 for fixed factory overhead, which was given us, the 5,000 for fixed selling and administrative cost, and we would have operating income of 27,000. Now, notice that that is greater. The operating income under variable costing in this example is greater than that of absorption costing. Because you remember I said the rule earlier, if you sell more than you produce, variable costing will give us greater operating income than absorption costing. And in this case, we sold 12,000, we only produced 10, so variable costing will give us higher operating income numbers. Now, what if we only sold 8,000? And now this is going to be a case where we produce more than we sell. We're going to produce 10,000, but we're only going to sell 8. So let's look at what would the numbers look like. We would take the 8,000 times the $25 a unit. We'd have sales of $200,000. We would take the 8,000 units sold times the absorption cost per unit and product cost per unit under absorption costing, and we would get 176,000. 200 minus 176 would give us 24,000. We would then take the number of units sold times $1 per unit for the variable selling and administrative cost, and the fixed selling and administrative cost would then be backed out as well, which would give us operating income of $11,000. Now, what would it look like under variable costing? Under variable costing, we sell 8,000 units. We'd take the 8,000 times $25 per unit selling price. We'd get 200,000. Then we would take the 8,000 times the $18 per unit product cost under variable costing, and that would give us what, 144. We would take the 8,000 times the $1 per unit variable selling and administrative cost, and we'd get 8,000. So 200 minus 144 minus 8 would give us 48,000 total contribution margin. Then we would back out again the total fixed factory overhead of 40,000, the 5,000 for fixed selling and administrative cost, and we would come back to $3,000 operating income. Okay, now notice that again, when we produce more than we sell, we're producing 10,000 units, only selling 8. Operating income will be higher under absorption rather than variable. And this is kind of what I was saying earlier, is that if you overproduce, if you produce more than what you sell, you're going to have better operating income under absorption than variable. This is an example of this here with the selling of 8,000 units and the production of 10. Now, the difference between the two is 8,000. So if we were to take what the 11,000 operating income under absorption minus the 3 operating income under variable, we come back to $8,000. Now, how you can explain that is that if you're doing variable, your fixed factory overhead is expensed off in total every single period. It's always going to be expensed off in total. But under absorption costing, basically the fixed factory overhead is part of product cost. So if you don't sell everything that you produce, some of that fixed factory overhead is going to remain in inventory. Not all of it is going to make it to cost of goods sold. Not all of it's going to be expensed off. So kind of a way to explain it is to look at the difference in the difference between production and sales, which in this case would be 10,000 minus 8,000, which would give us 2,000, times the basically the fixed factory overhead per unit in $4, that would give us $8,000, which would explain the difference between absorption and variable costing. So I hope this helps, and good topic. And remember that absorption is required for external reporting. Variable is for internal reporting. Many companies use both. Absorption for external, variable for internal. and remember that the difference in product cost between the two, variable costing, only variable cost or product cost, absorption costing, all elements of product cost are product cost. Remember, variable costing, expenses off fixed factory overhead each period, where that is a product cost under absorption costing. Okay, so thank you very much and have a great day.